Okay, hello everybody. Welcome to Korean Atlanta Mentorship. In this video, we're just gonna give a basic beginner's overview of what is a home equity line of credit. So you may have taken like some velocity banking classes or watched some velocity banking videos, and they might say something like, "Oh, a HELOC or a home equity line of credit is like the best tool for velocity banking," and you think it's this really exotic, mystical thing. So I'm just going to decipher it for you and break it down. Um, and assuming you're a noob or beginner, I'm assuming that's why you clicked this video, so we can kind of break it down of what a home equity line or a HELOC is, right? So that's the abbreviation. So you might see, oh, home equity line, and then they might call it HELOC, home equity line of credit, right? So let's just go over the first part or first definition. What is a line of credit? So a line of credit is a financial tool that will allow you to borrow money, pay it back, and reuse it again just as long as you have an available balance in the tool, right? So the most well-known example is a credit card, right? Because let's say I spend $5,000 today, I pay back the $5,000, then I can reuse it again. That's a line of credit. Now, a credit card is a little bit different from, let's say, other types of lines of credit, such as a personal line of credit, business line of credit, and home equity line of credit. There are some little differences and nuances here. I'm not going to explain it in this video, but just be aware that a line of credit, even though a credit card doesn't have line of credit specifically in its name, all it is a financial tool that allows you to borrow money, pay it back, and then reuse it over and over again. And that's kind of the main tool that we use for velocity banking. Now, if you have no idea what velocity banking is, I would recommend that you go ahead and click the link down below to Velocity Banking 101. It'll give you a great foundation of what it's about, and then you can come back here to figure out one of the main tools that we use for velocity banking. Okay, so we know what a line of credit is. Most of us, I'd say 99% of us have used credit cards. In fact, right now there's $1 trillion of credit card debt, so I know a good majority of people have used them. All right, if we scroll down, now we're going to decipher the term home equity, right? So what is home equity? All it is that basically you get the estimated price. So we're assuming that you're a homeowner, you own a home, right? If you're a renter, this doesn't really apply to you and you don't have what you call equity. But basically all home equity is you get the estimated sale price. So let's say you put a for sale sign on your front lawn today. When you sell that home, how much could you get for it, right? And that's the estimated sale price. It doesn't mean you're actually going to sell your home. It's like, what does the bank think you can sell it for, right? Minus any loans and debts tied to the house. So mortgages, it could actually be in a home equity line of credit, right? Any debts tied to the house. So you may have like three mortgages to the house, like with the big one and then like two junior ones, or you could, right? So anything that's debt, you just subtract it and that's your home equity. That's really easy, right? So let's say like I have a house and a real estate agent tells me, oh, okay, you could probably get $300,000 for it. How does the real estate agent or appraiser or any professional know what you could get as the estimated sale price? They base it something on comparable sales, or they call it comps. And then let me just put quote comps, right? So if you ever talk to a real estate professional, they'll be like, "Oh yeah, the comps say it's 300,000." What does that mean? It means that the homes in your area that are similar to the one that you own, um, hopefully in square feet and type and structure and the area, because the area matters as well, um, sold for X amount in the last 6 to 12 months, and they kind of get like an average of like the square foot. We're not going to do the math here, but just be aware they get that estimated sale price from comparable sales. That's how single family works, right? All right, so we get that, and then whatever debts you have. So you may have like a $150,000. We'll call it the first mortgage. Maybe you get a junior mortgage for like $20,000. So we'll call that the second mortgage. Usually anything after the first mortgage, they call it a junior mortgage, I think. And so in order to calculate the equity, it's really easy. All you have to do is just do the math. 300, 150 minus 20. So let's just put our calculator to do it. I'm actually a math major, but I love using calculators. I think everybody involved in math does, right? These days. So 150, 0, 0, 0, minus 20. 0, 0, 0. So what's my equity? My equity is 130,000, right? So my home equity equals 130K. That's what it is. Now, so kind of if I were to explain it to you like you were five, a home equity line of credit is pretty much like a credit card tied to your home equity. And so what banks do is they do the appraisal, they check how much debt you have, and they're going to give you not all of the equity, but they're going to probably give you like maybe 70, 80%, maybe even less depending on, your credit. So we'll just assume 80%. So 80% of home equity is available to use like a credit card, right? So what they'll do is just let me just kind of calculate 80%. So point times 0.8. So it's like having a credit card for $104,000 in this instance. So I'll just say available balance equals 104K, right? And again, this is just a hypothetical example. It's not always 80%. They might do less. They might do like 50, 60, just depending on your application and how the process goes. But what happens is they say, okay, you can actually borrow $104,000 at like maybe a 12% interest rate, right? And they might give like 0% introductory interest rates for like the first 6 to 12 months. Again, it depends on the lender, but they're basically saying we just gave you a big credit card and you could withdraw money into your checking account whenever you want, and as soon as you withdraw it, we charge you 12% interest. And so this is a great tool for doing velocity banking because you get bigger limits and the interest rates are usually cheaper than a personal line of credit and a credit card. Now, what is the main difference between this and a credit card? So I would say it's two things. One, it's secured, right? So what do we mean by secured? So basically, if let's say you don't pay off this home equity line of credit, right? Like you're late on the payments. Well, basically, it's going to be tied to your house. And the right way, I guess, to say is secured by your house. And so for this $300,000 home, um, they have the right to foreclose on you. Now, does it mean that they always will? Not necessarily, because banks in general will kind of do everything they can to not own property. And the reason also, one of the reasons why they don't give you 100% of the home equity is that if they foreclose, there's a lot of costs to it. So by the time, they're done foreclosing and selling your home off to the auction, um, they'll recoup probably what they have, but 20% of it or so of that home equity, they kind of have to reserve for the costs of foreclosing your home. But they want to get your money back. So it's kind of like, if you have some skin in the game, you're probably gonna pay them back, but not always. But it's secured by your home, so the gate your home is essentially skin in the game, right? So skin in the game. So they call it like secured by an asset that you put up as collateral, and you're putting your home as collateral just in case you don't pay back that line of credit, right? And then second main difference is that you can use it to pay anything, right? That's like the second main difference. So like a credit card, there's some restrictions of what you can pay. Like I can't pay most loans with a credit card unless I'm using Plastique, right? I can't pay a mortgage with a credit card. I can't pay a credit card with a credit card. Like it'll be weird if I made a credit card payment on the same credit card. But with a HELOC, a personal line of credit or a business line of credit, I can definitely do that. So let's say like I have like that $104,000 available balance for the HELOC, and then for some reason I'm withdrawing like $100, so $100 withdrawal, and then let's say like next month the monthly payment, we'll just do a hypothetical. I don't know how it's exactly calculated, but $25 minimum payment, right? Well, the cool thing about the HELOC or any sort of like personal business line of credit, if it has a named line of credit, I could just pull that more money out and then just pay it back. Like I literally can pay back the same line of credit with the same funds, right? That's the really cool thing about like these lines of credit compared to a credit card. Now, again, there's good, better, best, right? So if I don't, for whatever reason, I don't own a home, and I can't use home equity for a line of credit, right? So good would be like credit card. It's good enough. So there's some restrictions, higher interest rates. Better is like HELOC. Again, um, maybe the interest rates are a little bit higher and I don't get as much limits. And then best is like home equity line of credit, right? You get higher limits and the interest rates are usually lower than the other available options. So that's kind of like the two advantages or two main differences of a HELOC compared to, let's say, a credit card. One, it's secured. Now there are secured credit cards, but usually they issue them unsecured. But with the HELOC, it is secured by your house. That house is your collateral, and you have skin in the game. And secondly, you use it to pay anything. You could use the HELOC funds to pay the HELOC again. You know, so it's not necessarily robbing Peter to pay Paul. It's like robbing Peter to pay Peter, right? So it's really cool tool. Again, I have a HELOC, I have a PLOC, I got a ton of credit cards, I got lots of credit, and here's a secret to knowing whether you can get credit or not. Banks don't lend you money when you need it, right? So if you feel like, oh, I make money and I don't need money, that's the best time to like apply for lines of credit. The banks will just give it to you. Like you don't need it, so we'll lend it to you, right? In general, not 100% guaranteed, but that's the general rule. Okay, so I hope this was helpful. This is like the beginner's guide to a home equity line of credit. You just need to know the two terms, line of credit and home equity, and then you just ask the bank like, hey, I own a home, I'm trying to get a home equity line of credit. Do you think I qualify, or do like you just kind of find out what their programs are. I used the same lender as my mortgage because it was just much easier, and they said it was free. Like there's no closing costs. It's like, well, if there's no closing costs and it's like 0% um introductory rates for like 6 to 12 months, why wouldn't I do it, right? But yeah, so this is my personal experience. Okay, so this is Korean Atlanta Mentorship. If you're interested in joining our group and joining, let's say, a study group, because we're going to start a study group online, offline. I've already started a study group offline with two Korean people that I know, but you don't have to be Korean to join our group. I just called it that just because I wanted to create a local feeling of yeah, hey, we're an actual group, even though things are so disconnected online. You go ahead and click the Google form link below and say you're interested in joining, or you can find out our email address and send us an email on the About page of our YouTube channel. All right. Have a great day, and we will speak soon.